Good morning and welcome to Charting the Markets on Monday, the 15th of January 2024. On Friday, US earnings season for the fourth quarter of 2023 kicked off with major banks reporting, and the figures were pretty mixed, which led to a muted session at the end of last week in the US markets ahead of today's holiday for the Martin Luther King Jr. holiday in the US. So US markets will be shut today. You can still trade out of hours on the IG platform, though, a lot of US stocks and indices. Now, over the weekend, we also had Taiwan's presidential election leading to a win for the pro-sovereignty party, a move likely to increase tensions in the region. And we also saw heightened tensions in the Middle East over the weekend as US and UK warships basically bombarded military targets by the Houthis in Yemen. And that led to a rise in the oil price and could lead to further escalation over the coming days. Therefore, oil and shipping stocks rose and outperformed on Friday in the FTSE 100, and that was contrasted by luxury stocks, which underperformed as Burberry's basically issued a profit warning. And over the weekend, China kept its medium-term lending rate unchanged despite further rate cut expectations. And key events for this week basically include GDP data out for China and also Japanese inflation on Friday, while we also have UK inflation and employment data, which is out for release. Now, let's have a look at the Japanese market, and we can see here the Nikkei 225 has risen for all of this year, and this morning overcame the psychological 36,000 mark, and on this daily financial bet rose to 36,216 so far. And this is taking us back to levels last seen in January of 1990, as you can see here. And the next upside target is basically the psychological 37,000 mark, ahead of the October 1989 high at 38,957 on this daily financial bet. And you can see here on the quarterly chart that the advance from last year in the Nikkei 225 has been very strong and continues. And you can see here that basically the Nikkei continues to head higher very swiftly. And from a technical perspective, provided we stay above this earlier today intraday high we saw in the Nikkei 225 at 35,552, further upside is likely to be seen in Japan. Now, when we come to our local market here, the FTSE 100, we can see that last week we slid down on a higher inflation print out of the US with regards to the FTSE 100 and dipped down to 7,573, which was incidentally also where the red line is at the moment, the 200-day simply moving average, acting as pretty good support. And as you can see here, not much going on as the US markets are shut today, so little volume trading and also little volatility seen here on the FTSE 100. But from a technical perspective, as long as we hold above last week's low at 7,573, we may see a minor bounce back. But for that to happen, we would have to rise above Friday's high at 7,657, because only then could we accelerate further and perhaps retest the October high at 7,702. With regards to the German stock index, you can see here that the DAX 40 contract is also trading sideways above its current January low at 16,444. And here we need to take out a Thursday's high at 16,841 for us to resume our medium-term uptrend. But as you can see here, since December of last year, we're just trading sideways. On Friday, we had a slight push higher as Christine Lagarde, the ECB president, reassured markets that interest rates will once again fall once inflation is under control, and that led to a slight rise. And earlier this morning, we actually broke out of that Harami pattern to the upside. But as soon as the market opened in the open session here in the European markets, we then came off again again, with little volume going through the market. So from a technical perspective, as long as we stay above Thursday's low, which was made at 16,535, it is likely that we're going to see further sideways trading in the DAX 40 contract, and we need to take out Thursday's high at 16,841 for us to resume the upside on this index. Now, over the last few days, the US dollar has weakened somewhat, despite a slightly stronger than expected CPI reading last week. And we can see the impact on that on the British pound against the US dollar. And I'll show you that one in a moment. But before I do, I'd like to show you the euro against the British pound. As you can see here, that is also quite interesting because basically we are continuing to fall and slide and seem to be on track to fall through last week's low at 85.87, which would then take us back down again towards the December low at 85.50 as the euro continues to depreciate against the British pound on the expected interest rate differential, as we see probably rate cuts for the ECB, according to a Bloomberg poll, where we could see 4 25 basis point rate cuts starting at the beginning of June of this year, whereas the market in general anticipates to see 6 rate cuts starting in April. That's what investors are pricing in for the ECB this year, whereas the Bank of England is still likely to cut its rates more slowly than the European Central Bank, and perhaps not as early as the European Central Bank. And that has led to a slide in the euro against the British pound, as you can see here, take us down to the 86 area. And provided we stay below the last reaction low, as to say a low on the daily candlestick chart, which is higher than the one to the left and to the right. So provided we stay below the last reaction high, that's to say at 86.20, last Wednesday's high, further downside looks to be quite probable with regards to the euro against the British pound. But I mentioned the British pound against the US dollar, and as you can see here, we've been grinding higher since the early January lows at 126.11. And even though we're coming off today on very little trading here, as long as we remain above the November to January uptrend line at 126.76 on the daily chart closing basis, further upside looks to be in store for this currency pair as well. Now, last week we tried to reach the mid-December high at 127.94, but didn't quite manage to do so. But if we were to manage to do so this week, we could then retest the December high at 128.28. So probably more likely we are going to see a further continuation of the advance in the British pound against the US dollar over the coming days. And what is interesting also is that we are seeing a similar picture on this weakening US dollar with regards to the Chinese yuan. And as you can see here, we continue to advance towards the December high at 720, as the Chinese central bank kept its medium-term interest lending rate basically unchanged this morning, despite market participants expecting further rate cuts to help the economy on to a better footing. But as you can see here, we're trading, basically have been doing so for the last week, around the red line, the 200-day simply moving average, which comes in at 717.98. And from a technical perspective, provided we stay above Thursday's low at 716.17, further upside is likely to be seen with regards to this currency pair as well. Moving on to commodities, what I would like to look at is the impact the weaker dollar over the last few days has had on the gold price. And as we can see here, the price of gold has actually risen quite significantly over the last few days and has taken us to last week's high at around $2,064 per troy ounce. But we so far haven't managed to break through that high, even though we are on track for our third consecutive day of gains, having left this 2-week downtrend channel we've been trading in since the beginning of the year. Now, from a technical perspective, there is a pretty important resistance area coming in between $2,070 and $2,088 per troy ounce. And this resistance area consists of the 2020, 2022, and also the May 2023 highs, as well as the December 2023 highs. And they will probably be quite difficult to be broken through. So the area between $2,070 and $2,088 is targeted once we break through last week's high at $2,064. And this bullish view will probably remain in play, provided we stay above last week's low at $2,014 per troy ounce, which incidentally was made around the 55-day simple moving average here in orange at $2,017. Now, as I mentioned, the price of crude oil has risen over the last few days as US and UK troops, not troops, but basically drones and also missiles hit Yemen and hit Houthi positions there, which have been attacking the shipping lanes in the Red Sea over the last few weeks. And you can see here that we did on Friday rally all the way to around $80.50 before coming off again, as the situation, at least short term, seems to be quieting down, and as no escalation has as yet been seen with regards to the Iran-backed Houthi so-called rebels by some. And basically we can see here that the oil price on WTI is currently slipping back, but is still trading sideways between the highs seen at the end of December, around $81.44, and the low in early January, around $74.81. So as supply remains for the time being quite high, and demand with regards to the second, or the actually largest oil importer in the world, China, still being lackluster, these fundamentals, at least short term, seem to be outweighing the worries about supply concerns to do with the heightened tensions in the Middle East, at least for the time being. Last but not least, I'd like to also talk about natural gas prices, which last week had risen quite substantially on the current cold snap we're seeing, not just in the US, but also in the European region. As you can see here, we valued to $3.12 last week before coming off again and retesting this red line here, the 200-day simple moving average at around $2.73, which incidentally is being retested at the moment. So here, if we were to fall through Thursday's low at $2.72 on a daily chart closing basis today, we could actually slide further and most likely will retest the December to January downtrend line, which currently comes in around $2.59. So that is a distinct possibility for the days ahead. We've got some minor resistance with Friday's high, because as you can see here, we created a price gap when there is no data traded between the low we saw on Friday at $2.81 and this morning's high at $2.79 at the time. For the time being. So basically, as long as that gap remains open, there is a possibility that we may try and close it, but provided we stay below Friday's high, which was made at $2.98, I expect further downside to take us to this December to January uptrend line around the $2.58 mark. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X. My handle is Axel R_IG.